Namaste and welcome. Today we are diving deep into a cornerstone of the Indian pharmaceutical industry, Cipla Ltd. Founded in 1935, Cipla has evolved from a local drug manufacturer to a global healthcare giant. For investors, Cipla represents a blend of legacy stability and aggressive future-oriented growth. With a presence in over 80 countries and a portfolio spanning 1,500 products, it is more than just a stock. It is a vital organ of the global health ecosystem. As we look at the current market landscape, Cipla stands out for its robust domestic leadership and its strategic pivot towards complex generics in the U.S. Whether you are a seasoned professional or a retail investor, understanding Cipla's trajectory is crucial for a balanced portfolio. Let's explore why this 88-year-old giant is making waves in the era of AI and precision medicine.
When evaluating Cipla, the numbers tell a story of consistent efficiency. For the financial year 2023-24, Cipla reported a staggering revenue of approximately 25,000 crores rupees. But revenue is only half the story. Their EBITDA margins have consistently stayed around the 24% mark, showcasing excellent operational control even amidst inflationary pressures. Profit after tax has seen a healthy year-on-year growth, driven by strong sales in the Indian chronic segment and a recovery in the South African market. For investors, the most attractive feature is the debt-free nature of the balance sheet. This financial flexibility allows Cipla to invest heavily in R&D and strategic acquisitions without the burden of high interest costs. This is a company that knows how to manage its cash while fueling its growth engine. Cipla's strength lies in its balanced revenue mix. The domestic Indian market contributes roughly 43% of total revenue, where Cipla is a leader in respiratory, anti-infective, and cardiac therapies. 1 in every 3 asthmatics in India uses a Cipla inhaler. Then we have the North American market, contributing about 28%. Here, the focus has shifted from simple generics to complex generics, like peptide-based injectables and respiratory products. The South African business, integrated through Cipla MedPro, remains a top-tier player in the private OTC market. This geographical and therapeutic diversification acts as a natural hedge. If one region faces regulatory headwinds, another provides the tailwinds. This multi-engine growth strategy is what makes Cipla a resilient pick for long-term wealth creation. The U.S. market is the ultimate testing ground for pharma companies, and Cipla is playing a high-stakes game of complex generics. Unlike simple pills, complex generics like Advair and Abraxane require specialized manufacturing and clinical trials, creating high barriers to entry. Cipla's success in launching lanreotide and the expected approval of Abraxane are significant catalysts. These products offer higher margins and face less competition compared to standard generics. The company is also making strides in the Revlimid opportunity, which provides a steady cash flow. While U.S. FDA inspections at facilities like Patal Ganga and Indore have caused some volatility, the management's focus on zero-defect manufacturing is aimed at resolving these issues. For the investor, the U.S. pipeline is the primary driver for future valuation re-rating.
Cipla is not just a drug maker, it's becoming a digital-first healthcare provider. By integrating artificial intelligence into its R&D processes, Cipla is significantly reducing the time required for drug formulation and discovery. They are using AI-driven predictive maintenance in their smart factories to ensure 24/7 production with zero downtime. On the consumer side, their Caring for Life philosophy is supported by digital platforms that provide diagnostic support and patient adherence tools. For instance, their AI-powered diagnostic tools for respiratory health help doctors identify issues faster. This digital layer increases customer stickiness and operational efficiency. Investors should note that companies embracing AI early, like Cipla, will have a massive cost advantage and a faster time to market for new drugs in the coming decade.
Innovation is the lifeblood of Cipla. The company consistently reinvests about 5% to 6% of its total revenue back into research and development. This isn't just about making cheaper versions of old drugs. The focus has shifted toward biosimilars, mRNA technology, and specialized respiratory devices. Their R&D centers in India and abroad are staffed by thousands of scientists working on solving unmet medical needs. This commitment to innovation is what allows Cipla to command a premium valuation compared to some of its peers. The recent focus on wellness and preventive healthcare through their consumer health division, Cipla Health, is also born out of this R&D mindset. By creating brands like Nicotex and Coughsills, they are capturing the entire patient journey, from prevention to cure.
No investment is without risk, and for Cipla, regulatory compliance is the biggest watch-out. The US FDA's frequent inspections of Indian manufacturing sites can lead to Form 483 observations or warning letters, which can delay new product launches. Currently, resolution of issues at the Patalganga and Goa plants is a key monitorable. Secondly, the domestic market is subject to price control under the DPCO, which can cap profit margins on essential medicines. Thirdly, intense competition in the US generic space leads to price erosion, where the price of a drug can drop by 10 to 15% annually. While Cipla's shift to complex generics mitigates this, it doesn't eliminate it. Investors must keep a close eye on FDA news and government pricing policies to manage their entry and exit points effectively.
In conclusion, Cipla is a high-quality pharma play with a strong balance sheet and a clear growth roadmap. For a professional investor, it offers a combination of defensive stability and upside potential from its U.S. pipeline. Currently, the stock trades at a price-to-earnings (PE) ratio that is in line with its 5-year average, suggesting it's not overvalued. Analysts often set target prices based on a 2022x forward PE. With a steady 12 to 15% expected earnings growth, Cipla is well-positioned for compounding wealth. However, the best strategy is often buy on dips whenever regulatory news causes temporary price drops. Cipla's commitment to AI and complex medicine ensures it will remain an industry giant for decades to come. Always consult your financial advisor, but for many, Cipla remains a core holding in an Indian equity portfolio.